Ladies and gentlemen, welcome to the Big Tech Frenzy. This live stream is going to be broken up into two separate parts. One, a conversation about Chime and its comparables to SoFi technologies. The second part, which is actually going to be our first part, is SoFi Technologies 10Q that has just been released, where we get to see the full picture of Q2 earnings. Guys, I've went through it. It's beautiful. There's nothing to hate here. It's unbelievable how good this business is doing. And we just get to see more data to prove that thesis correct. And I mean, wow. Including Chime. I mean, SoFi's up in the after hours, probably because the 10Q is out. But wow. It's Chime just goes to show you, like, whenever you compare the multiples on Chime versus the multiples on SoFi, and we can do that in this live stream as well, it just puts SoFi at such a cheap multiple. It's such an amazing business. Anywho, let's go ahead and talk about SoFi Technologies. Let me make this a little bit bigger so we get a full scope. Now, if you guys know, if you haven't seen the channel before, I have a lot of data on SoFi Technologies, okay? A lot. And sorry, I got distracted. It just kept scrolling. I was mind blown by my own charts that I've made here. The 10Q ends up showing off these new pieces of data that we weren't able to see before, like the cost of their debts, the actual default rates of their loans, and in this case, the average cost of funding and the average coupon rate, how much we're actually making on things like home loans, student loans, and personal loans. And then we get a net spread, okay? So if I can potentially make this a little bit bigger for you guys, what you can end up seeing by... Where am I going? I'm getting lost in the sauce here. There we go. What you can end up seeing is that as the average coupon rate has held strong, and although it is coming down a little bit, the cost of funding has dramatically fallen over the last 4 quarters. And so this allows our net spread, how much they are taking from charging for an amount while paying off amount, not including default rates, is actually climbing up. But that's very dependent on default rates staying low. So then the, actual payments that SoFi gets from their loans ends up staying high. However, if we go ahead and look for this chart here, this is SoFi's loan default rate. And I could try to make this big on the text as well for you. But essentially, what it's showing is that SoFi's default rate ended up falling, not staying low, but falling quite dramatically. And then, so this in the orange is assuming, okay, well, if we kept every dollar of our late stage delinquent loans, which means, people between 90 days and 120 days of no repayment, SoFi ends up taking those loans and at the last 4 quarters sold off $90 million worth of those types of loans to a collector, someone who's willing to pick up the phone, send you mail, harass you until you start paying it back. Funnily enough, it actually works. But SoFi doesn't want the headache. So they sell off those $90 million worth of loans, collect a mid double digit range, somewhere between 15 to 21% of the actual loan amount, and just say, you know what, if they can collect it, that's their money to make. Let's just take a little haircut here. That's what actually shows up in blue. So this is the default rate excluding the sold loans. The blue or the orange is the default rate whenever you include the default loans, not including them actually getting paid 15 to 20%. So essentially, I'm sandbagging the numbers here. It's even better than what you see. Okay. So that is falling. Cost of funding is decreasing, and the overall average coupon rate, which is how much they charge for their loans, is staying high. It's a beautiful sign. We want that green to go up. We want the orange to go up. We want the blue to go down. Okay, let's reset that really quick. And then we'll find the next one. So just stuff like this is also important to keep an eye on for SoFi, which is the amount of deposits that are, or sorry, the amount of funding for our loans that are staying deposit led, which as you can see, for some reason it's hiding behind those charts, that it's still above 90%. Okay. And some of it might be capital funded because we're using all of our warehouse facilities. So some of it's SoFi's money, but you can see how it's transitioned over time. It's gotten very, very good. And we'll keep monitoring it to make sure that it doesn't fall below, 90 or 85%. Okay. Another big part of the 10Q that ended up getting released was credit cards. Now, I know this is extremely hard to see because the yellow portion is obviously the hardest color to read. I should have thought about it more. Okay. But this is credit card loans that SoFi holds on a FICO score basis. So the highest is actually this low here of under 640 FICO, which is not what you actually want to see climbing. But I'll show you why it might be okay. The other two extremely fast growing lines is the 680 to 699 and the 700 to 720, which are on the lower end of the bands. The next biggest is actually the greater than 800. So it is a very weird spread. And there's really not too much you can get out of this other than they are accelerating their credit cards across every single FICO score range. Okay. From that, we can end up seeing how much loans or how many loans they have across every single FICO score added up. And then we get to see how many loans that they are holding all together. What that ends up showing us is two things. So this one, first of all, this is how many credit cards SoFi has outstanding, which is in the purple. It's 344,400 credit cards amongst U.S. Consumers, young U.S. Based investors that usually have higher end FICO scores. But on the credit cards, it's one of those products like we just saw that it can be a little bit selective. It's not nearly as FICO like prime user or prime plus user as the personal loans, home loans, and student loans are. And we can talk about that in a second as well, because we got a lot of data there. But the average debt per credit card account has been falling quarter over quarter over quarter for a long time. This past quarter, we just saw a quick little bump up. Now, we've seen bump ups before back in Q4 of 2023. So we'll have to see if that becomes a trend. But overall, we saw a massive increase in overall credit cards and an increase in debt per customer. So credit cards has skyrocketed this quarter. The next major one, and this is by far, if you guys have anything to take away from the charts that I'm going to show you here today, it's this number right here. And I'm going to make sure I bold this a lot. Let's go to 24. Okay. The numbers that you see on screen is the credit card default rate. Now, we were very worried about SoFi's credit cards back in 2022 and 2023. And you can actually see this got up to about 16.4% default rate, ended up falling down to 15 and hovering there for a quick minute. And you can see how the amount of loans that SoFi had given out during this time stagnated, came to a complete halt. Okay. If we go back to the credit card products, this was growing, halted. You have like a full year where this bar barely grew. Now, the last 2 quarters, we saw a jump and an even bigger jump up. So they're ready to accelerate again. Okay. Wait, sorry. How do I bring that back? But on this default rate, which somehow I have to build again because I messed it up. If we go ahead and take a look at, oh gosh, so freaking annoying. Okay, if we go ahead and blow this up, you can see here that 13.8% in Q2 of 2024 was the last time that we had rates this high. Then it was 12.1, 10.4, 9.1. Sorry, I was just hidden right behind my camera. And then Q2 of 2025, 6.56%. This is a massive improvement on their amount of credit cards. So now they feel confident to ramp this product up, now at $400 million, and by far the lowest default rates that we've seen since Q4 of 2021, back whenever we only had $120 million to our name on credit cards. Okay. If it continues, by the way, the range that would feel comfortable as a credit card product is 2. Anything lower than 2 is unbelievable, but 2 to 8% is okay. 6.6% or 6.56 or whatever it is, great. If this continues to fall in this sort of range and we end up averaging at around a 4 or even a 3%, you guys are going to see the most accelerated, like the $1.5 billion that SoFi just raised will go to credit cards. like you'll see the biggest promotions that we've ever seen on credit cards. They'll continue to push it if they understand the underwriting for that product now. So yeah, that's very, very, very important to keep an eye on. Let's go back now. What other data? Total loan sales. So I had thought that they said in the earnings call, but I think the transcript ended up getting ruined, or I'm not sure. But they said $200 million of personal loan sales. It wasn't the case at all, and it made no sense to me that it was so low. Whenever we actually reviewed it in the 10Q, that's not what ended up happening. And in fact, we saw very, very healthy numbers of, let's pull this just a little bit bigger here, of $2.45 billion of loan platform business, which we've already known about, and $3.4 billion of loan sales. So the highest amount of loan sales since we've been tracking this company as a public business. Okay, I can even pull up more data, all of this data as well. And yeah, we're not even close to being, actually, no, there was one quarter in Q4 of 2020 where we sold 3.6 billion, which I think was a big student loan dump, if I remember. What was the quarter? Q4 of 2020. So let's go ahead and take a look and we'll try to find out where those loan sales came from. Loan sales for personal loans, 900, yeah, it was right here. So we were selling 690 million, 850 million, then 2.3 billion in student loans that quarter, and then back to 900 million. It was just this massive student loan dump in this quarter. I don't know why. Aside from that, we ended up seeing an unbelievable amount of personal loan sales, home loan sales, and then loan platform business, which is just incredible. Let's drop this again really quick because it just makes the chart a little too busy. Okay, cool. So that's all good. Let's look at another chart now. Loan portfolio. So as you guys can see here, we'll ramp up the numbers a little bit. Bring up the numbers and do the same over here. Could have selected all, I guess, but I didn't do that. I apologize. This is SoFi's total loan portfolio broken out across different mixes. So, for example, home loans makes up for 1.2% of all of SoFi's total loan book. Student loans makes up for 35%, okay? And personal loans makes up for 63.8%. The most it's made up for was 70.7%. You can see where the blue maxes out here at 14.8 billion. But at the highest it's been was 14.8 billion. We're now at 19.6 billion at a lower percentage of total loans because they've just grown the pie so much that even the split that we can talk about is just better diversification. Probably the best diversification that we have is at the earliest here, Q3 of 2021, where you can see 3.9% home loans, 53% student loans, 42% personal loans. But it looks like we're honestly getting to that trajectory. Student loans is actually falling as a percentage of total loans being held on the books, because a lot of that's going out to loan platform business, so other asset managers, and that's allowing them to grow their student loan portfolio and their home loan portfolio as well. Even though like it looks like home loans is not growing all that much, but really you have to see how many loans that they're selling on home loans. So take a look at this, for example. It looks like we don't do a lot of home loan business, and to some extent we don't. But like the red line looks like a tiny little sliver, as if we barely touch home loans. Okay. But the truth is that whenever we actually go and look at the data and break it out, we originate $800 billion, $800 million of home loans a quarter, but we sell 777 million. That doesn't really allow you to build up your book very quickly. Okay. And this has been constant, right? You see 300 million originated, 350 million sold, 336 made, 344 sold, 420, 380. Like we sell every amount of home loan that we bring onto the books, plus or minus, $50 million. So sometimes you see more sales than you originated. Sometimes you keep 50 million extra. But that's the flexibility of SoFi's business, right? Is that whenever you have a business that is this, such a one-stop shop, you can choose if you want student loans, home loans, personal loans to originate more in. You can choose if you want to sell those loans or hold them on your books. SoFi gets to be, the manager of what is most beneficial to them, okay? Without the consumers even facing any sort of penalty for SoFi's own actions, because they can throw, if there's more customers that end up coming through the books and SoFi doesn't want them, they can throw them through the loan platform business. They can give them over to Pagaya, and Pagaya can end up selling them onto, their B-lending marketplace. They just have so much flexibility. And this is why I'm super excited about the dilution and not mad at it at all, is that if they've already said that it's going to be EPS neutral, which I think is a load of BS, I think they're going to do better than that. It gives them ultimate flexibility to further the growth even more, and which hopefully, if we end up seeing higher growth rates and EPS neutral or better, then that just means that the stock price is going to go higher, because analysts will have modeled the company incorrectly, right? If one day we start adding into buybacks and bringing the share count down, which, by the way, quarter over quarter, it actually did go down. Not many people saw that, but it actually did go down because we had some expiry of, it was either the convertible notes or options vesting that didn't actually end up getting paid out or something like this. But fully diluted shares ended up going down by about 3 million shares. Something like that. Let's see if I can find this here. Yeah, outstanding shares went from 1.185 billion to 1.182 billion without any buybacks or anything. Just a little interesting. There was no added dilution this quarter, for which a lot of people were assuming, including myself, that they were going to have additional uptick in more shares, which makes EPS lower. But that wasn't the case. It will be the case next quarter, though. So don't get your hopes up too much. Let's see what else there was in terms of charts from the 10Q. That was really interesting. This one was very good. We can talk about this one. So let's bring up the font here really quick, and then we can talk. So this is, and that's not even big enough, probably. I'm sure it'll be fine. Anyway, this is the net charge-off rates, or what we lose from the loans that we end up giving out, okay? Notably, we sell off every single home loan that we have. There's no default rate. Personal loans saw an unbelievable decrease, like we showed off prior. And then the student loan upcharge was actually from them saying that they purchased a student loan book of loans that ended up having a higher loan loss rate or something like this, but it was factored into the price of what they paid. But if they didn't have it, then student loan default rates would have looked exactly like what it looked like the quarter before. So everything is the same. They're just, their parts of their business is still a bank, and they're making strategic investments. So that part doesn't really matter too much. And whenever you look at the wherever their loan book is, the fact that you see personal loans taking such a dive down, like, just keep in mind what percentage of the overall book is personal loans. If they're getting better and having lower default rates on that, that's going to make so much more of a difference than any amount that student loans could correct up on the default rate percentage. So very cool. This was another chart, not from the 10Q, but one that I didn't really highlight before, and my chart's too big that I can't even see. Oh my gosh, I hate that it's folding underneath the other charts here. Okay, if we go ahead and look at the percentage, that's too big. At the percentage of stock-based compensation to revenue, how much the company is making versus how much they're giving out to employees and C-suite executives and all of these things. At one point, the big bear case for SoFi was that 27% of their stock-based compensation, 20% of their revenue was stock-based compensation. It's insane to be that high. 20 plus percentages is insane levels of unreal SaaS execution, and everything's going well. 25% plus, you're in the loony bin. Okay. 27 was crazy. That quickly started to adjust, brought it down to 13%. Analysts said that, Wall Street executives said, hey, we're going to try to get this into the single digits next year. Next year came, and yes, they did that all the way down to 7.4%, which is really starting to get into acceptable range. I would say an acceptable range, especially for the speed at which SoFi is growing, is 9% and under. Whenever you're talking about really mature businesses, you want to be under 5%. Okay. And then insanely well executed businesses, I like to look for, if you can find something under 3 or even under 2, those are like, oh, okay, wait, stock-based compensation is actually being like done very well. But it comes with its strengths, right? Either you're giving it out in cash or you're giving it out in equity. It's sort of weighted in the same direction. Now, do you do the Robinhood-esque approach where you pay a lot for employees and then you get really high execution because they feel like they're working as if they own the business? Well, I mean, that's kind of true. If SoFi is saying, hey, we're doing the SoFi way where all the employees feel like founders, how can they feel like founders if they don't have share in the business? So something to monitor closely. But so far, great trend. Going from 27% to 7%, that has to be rewarded by shareholders. Overall, I'm going to show you guys some. This is not a non-GAAP chart or like this is officially reported by SoFi, but I'm going to show you guys here in a second some non-reported charts. One sec. It's got to be water time. Give me 1 second. Stockgoat said $75 by end of week. Is this true? He didn't actually say that, right? He probably didn't say that. He probably did call for $75. Get some coffee or water, Tanner. I know. I have a lot of talking today. Jeez. And also, that's not what I meant to click. We're falling apart. We were on such a good streak here. Lending interest earning. So this is just essentially adding up all the personal loans, home loans, and student loans that SoFi has on its books to show how much money are they just making, sitting on their loan portfolio that they already have. I think this is on an annualized basis, so it's at 719 million, which is just incredible. I'm also curious if I included credit cards in that. I'm sure I did, but yeah. Also, did we talk about website traffic? Guys, if you guys did not see July's website traffic. Boy, oh boy, you're going to love this. SoFi's website traffic for July is now the highest we've ever seen, about 10% increase month over month, and beating out by over 1 million new visits from their previous high of March of 2025. Even if I expand out this data all the way till whenever I started, which was April of 2023, like, guys, look at this. And I'm aware, like fully aware, that SoFi is an app, okay? The main amount of people that are coming onto its web or coming onto the platform is not via website. But I think that it's a good indicator for overall traffic. Now, you guys could say, hey, Tanner, that's an assumption that's not based on fact. But I've been predicting SoFi's member count growth and earnings for many, many quarters. And we are very close to understanding how well this business is going to do. In fact, out of every single one of the creators that ended up putting out new member ads, I was the closest at 840,000. Okay. So I use this type of data to pull out those numbers. I trust it very much. It's worked out so far. SoFi's July is looking good so far. Very, very good. And also, if it doesn't add to the thesis even more, the year-over-year growth on this month was 35%. 35%. How much member growth is SoFi expecting each and every quarter? Let's go see. Member growth right here, 34, 34, 34, 33.8. We are right around the 35 range. That's just how fast we've been growing members recently. Okay. In fact, whenever SoFi was, or whenever Anthony Noto, this is not updated for Q2, so I apologize, but we did end up getting like this was projected to do 820,000 members. Okay. On a net basis, we got 829,000. We're 9,000 off from a projection of just taking Anthony Noto's comments of getting 50 million members in 5 years or whatever it was, and taking out the average growth rate of 7.52%. Okay. If we just extrapolate that 7.52%, that's roughly bringing in 34.6% year over year growth for Q3 of 2025, which just somehow lines up extremely closely, 0.35% of where website traffic is coming in right now. I'm telling you guys, website traffic is pretty dang accurate, but it also assumes that we bring on about 880,000 new members. Okay, the next quarter after that, 950,000, and then in Q1, 1 million. All I'm assuming here is based off what Anthony Noto has said, that he thinks that SoFi is going to be at 50 million members by Q2 of 2030. Maybe it's not going to be as linear as I've charted it out here, okay? But so far, we are on pace to succeed his goal. Right now, we're actually faster growth right now, which probably means that it'll be slower later on. I mean, growing 3.5 million users quarter over quarter whenever you're going from 46 to 50, that's going to be a lot. But anyway, let's get back to what we were up to. I was showing off a chart to you guys before. You might have to remind me what we were looking at. Oh, sorry. We were looking at lending interest earning. I want to show you guys two charts. In fact, we might actually be able to just skip one of them. But first of all, let's look at this first. Actually, I've got two more. This is also from the 10Q. The 10Q also shown off the risk-weighted assets that SoFi has, and then the minimums that we have to have. Okay, so we have to have a minimum on our risk-weighted capital minimum of 10.5%. But because our total risk-weighted assets is going up, that minimum increases. So we increased that by about $400 million more quarter over quarter. Okay, we're now at risk-weighted assets of $33.5 billion. An insane jump up quarter over quarter. Another part, so essentially what that means is this. SoFi has to have a certain amount of capital to make sure that like the loans that we give out a lot of the time, it's actually leveraged, right? They're using customer deposits to fund their future loans. So what this is showing us is that SoFi needs to have some form of capital that is actually theirs, not just, customer deposits, and we can just grow infinitely based on customer deposits. We need some form of real money. And so they make sure that you have at least 10.5% of your money in cash. Okay? Cash or cash equivalents, these sort of things that are easily liquidatable to handle a large increase of defaults. Okay. And then they simulate those types of losses based on stress testing, and they have to do that with the Fed, and they do that internally, and they get third-party auditors and everything like this. This is where people think that SoFi is just a bank, right? These are banking activities. This isn't tech activity. But still, on the banking side, SoFi is forced to hold more and more dollars, which is actually bringing down their total risk-rated capital ratio. This cannot get below 10.5%. 14.4% is like the difference between 16% and 14%, huge difference. Okay, you're essentially cutting it by 33% or so, because the bottom is not 0. The bottom is 10.5. That's the legal minimum. So I don't think you're going to see this get any smaller for SoFi at 14.4%. Now, I will say there was a part in SoFi's guidances going forward where they said that they were going to have a 16% capital ratio at the end of 2025, which is decently high. Okay, I like 14 to 15%. I think it's a nice well, it depends on the macro that we're in, but we're in a very comfortable macro environment right now. That's why they're probably holding it at a lower level. But you don't want to see it get like the true minimum is probably 12.5. Okay, regardless. The thing that I wanted to say there is that if SoFi feels very comfortable right now in this environment, they will lower this. And in their guidance, they said that they were going to keep it at a minimum, they were going to keep it at 16% risk-based capital ratio, but we're already at 14.4%. So are they going to re-up and add more capital to the books? Or, like what we saw in their guidance, and we're going to take a look at that later, there was no number update there. If you actually see, they did not reiterate that they're going to do 16%. So maybe they're in just full growth on mode. They don't see, many losses going forward. The default rates are actually falling. So maybe they're just like, hey, risk on, let's go. And I'm here for it. I mean, I'm pretty excited about that as well. I don't know if we talked about debt, but SoFi's debt levels are similar to where they were before. Okay. We got rid of preferred shares, and revolving credit stays in a similar place. That means that SoFi's debt expense quarter over quarter still lays at $10 million per quarter. This is just for business debt. Okay. What SoFi uses to, grow their own business, not necessarily the loan platform and those sort of things. This is like their internal debt, if that makes sense. It's not worded very well, but you get what I mean. Tangible book value growing, very much a bank metric, very much doing well. This is what stops the Timothy Switzers and all of these guys. I forget what the other Giuliano Bologna, who I think reiterated his $6 position on SoFi. Like, come on, guy. Even Timothy Switzer, who also had like a $4 or $6 price target at the time, is now at 14 because he sees how much the business is actually improving. If you end up seeing that the cost of funding is going down, okay, the default levels are going down, the amount of members and revenue and everything is all going up, how can you possibly put a $6 price target on the stock right now? I understand if you don't want to put a tech multiple, but at least go from $6 to $8. Like, you're saying that there's no improvements right now? Like, I don't understand. Okay? Like, just take a look. The cost of funding for SoFi is going down. Warehouse interest peaked at 6.55%, now at 5.2%, And deposits peaked at 4.29%, now dropping to 3.36%. Now, I don't anticipate, deposit interest might continue to drop if rates cut in September and these sort of things. Interest rates usually follow that. But they also are doing promotions like allowing people to get up to 4.5% interest. It's not going to raise the entire maximum. That's only for new members that are signing up for SoFi Plus, and that's only for 6 months, meaning that if you actually look at 4.5% on an annualized basis, it won't even be 4.5%, because they're only paying out that 0.7% extra for 6 months. So it's actually only 0.35% annualized as a bump. Yeah, I don't know what some of these analysts are thinking. I could see you guys sort of expressing this. Like, I don't know how an analyst takes a look at total revenue, which if we looked at the growth rates between these, it's doing very well. But then the growth rates on contribution profit doing even better than revenue. The growth rates on adjusted EBITDA are doing even better than contribution profit. And then all the way down to the fastest grower, which is net income. They're at smaller bases. I completely understand, but the operating leverage is so unbelievably real here. All right. What else? We looked at the deposit funding. By the way, this will be the greatest segment of SoFi's business going forward. This is financial services, as you can see. And what you see here in blue is the revenue, which continues to spike up. But the margin, the profit is growing even faster because we have margin expansion on top of revenue growth. So imagine if we made 10% of every dollar of revenue. So every dollar we get 10 cents, 10 cents, 10 cents. So if that doubles year over year, our contribution profit would double. But if somehow you get your 10% up to 20% and you double year over year, that actually 4Xs. You're not 2Xing that, you're 4Xing it because you doubled the margin. That's what's happening here. Okay? We are improving our margin year over year from 31% to 51.9%. We're getting 20% more on every dollar, and the dollars have doubled. More than doubled. We went from 176 million to 362 million and made 20% more on every dollar as we grew through that. It's an incredible business. Everyone wants to talk about the tech platform. It's like you guys are too narrative driven and not looking at the numbers. The financial services platform is everything the AWS of fintech investors should want. It's higher margin. It's faster growing. It has a 1,000x larger total addressable market. I mean that for real. I think the total TAM for the back end for banks right now in America is something like $20 billion a year. Financial services as a line item across all of the US is you're talking hundreds of billions, maybe $500 billion. It's insane. Let alone loan platform businesses, credit cards, marketplaces for every, insurance product and everything. It's so much money. So I think that's it for the 10Q right now, unless we didn't cover anything else. This was also new, FICO scores, but everything seems to be in order. Student loans held up a very high 768. Oh, you guys can't even see that, eh? That's all very small. 1 second. Apply to all. Try to bring that up. Boom. Student loans now at 768, home loans at 749, and personal loans at 743. Gotta love it. All right. And there we go. There wasn't oh, sorry. I do have more charts for you guys. I show off this thing called potential interest, which is essentially looking at a company's ability to write a loan and then see how much they could make on each loan that they've written if they did not sell off any of their loans. Now, the actual number and the importance of this chart is not really important. the next chart I'm about to show you is much more important, but it just goes to show you the size of personal loans in general, how important they are to SoFi, the size of home loans and how important they are to SoFi, and the size of personal loans and how important they are. Okay, that part is important to me. And in fact, yeah, I was going to change it, but it really doesn't matter compared to the next chart that I'm about to show you, which I don't know where it is. The bad part about doing all of this on Google Sheets is it's not very organized. But we do have the data. Okay, let's take a look. It should be. I'm looking for net potential interest. That's what I'm looking for. Any net potential interest? Oh, literally the last one. Well, actually, that's not true. This is, but net potential interest. So now this chart grows on that last chart. Now what we're taking into account is what is the chance that SoFi is defaulting on those loans? What's the cost of the actual of cost of funding and operating those loans? Okay, what's the potential interest that they could make if they held on to every single one of their loans? The reason why we need to look at this is because if we can make a lot of money, net profit, then that means that we can sell those loans for a lot into the future as well. Okay. And that direction for which those loans are going in is very important to me. So while this was falling off a cliff in Q1 of 2023 to Q4 of 2023, there were a lot of people that were saying, hey, you know what, SoFi is doing very well. But this chart actually spelled out the truth, which is what a lot of analysts were also seeing, mainly doing by institutional channel checks by saying, hey, you know what? Are you buying SoFi's loans? No, we don't have any appetite for it, and yada, yada, yada. But the truth is that the potential interest of those loans were just down. That's no longer the case. SoFi is maximizing the profitability of their loans. And now that's at a new all-time high for them. So very excited about that. It means that the quality of their loans are at the best they've been. We're seeing the lowest amount of default, but yet the highest amount of coupon rate. So it's not that we haven't seen lower default rates before. We have, but have we seen them with, this high of coupon rates? We're not getting paid 6.7 or 7% like we were before. We're getting paid 10.5% on average. So that's the mix that I think is very important here. Okay. Also, another chart that I like, just while we're reviewing many of the charts that I have on this spreadsheet, is just the margin on everything that SoFi is getting, just constantly improving. Very, very nice chart. And that's only going to improve over time. The more customers that SoFi has on their platform, the cheaper they get over time. So they pay a certain amount, which are their fixed costs. But as a percentage, if you only have like one customer or a few customers, your fixed costs can be very high. But if you add on, let's say right now we have 11 million customers and we're going up to 50 million, those fixed costs end up lowering as a percentage of total expenses, which is how you improve your margins to some degree. You can also do other things that also improve those margins as well. But SoFi wants to hit all those levers, okay? That's what I really like about this business. Okay. Now, can we get into Chime a little bit and the comparison between Chime and SoFi and why I am a big believer that SoFi is at an incredible deal right now? Okay. It's mainly that, we look at SoFi's growth rates and we're watching all the levers of what we're seeing and we're following Chime's, and they're a more expensive business, not on a market cap perspective. I don't mean on total size of a company. I'm talking about on the multiples that you would pay on a multiple of revenue, on a multiple of net income, on a multiple of gross profit. Pick your multiple. Bank of America versus SoFi. So it's the same thing. You can look at the multiple for Bank of America and see that it's much smaller than SoFi's. Like it would actually say that Bank of America is much cheaper than SoFi, But then you have to start factoring in growth. Okay. Where is Bank of America going to be 5 years from now? What's the total amount of EPS appreciation that they're going to see, or revenue appreciation? Probably EPS, what people are most excited about, right? What's the total shareholder return for Bank of America over the next 7 years? What's the total shareholder return for SoFi over those next 5, 10, 7 years, whatever the time frame is? That's where growth gets priced in. Now, for me, I think it's definitely in the value of SoFi. If I thought it was the other way around, I'd be a Bank of America investor right now, but I'm not. Okay. Chime versus SoFi. So we do not have a lot of data on Chime. Okay. They're a new business. They're finding out what data to show us. We're trying to figure it out. However, we do get to see some data. They're selective, but we can go maybe as far back as Q1 of 2022 on selective data. So that's the data that we're going to stick with and run with. We have total revenue at 528 million. Okay. Year over year, growing 37%. And then on gross profit, this is a margin, but I don't have it on a year over year basis. But essentially, you can see here, it is improving about the same rate, if not just slightly more than total revenue, because margins are improving as well. And then if we go down and take a look at adjusted EBITDA, for example, we're at 3%, not 28% like what SoFi is doing right now. And in fact, let me switch over to this view, so then we can switch between them very quickly. All right. Okay, let's do it this way. So, whenever we look at adjusted EBITDA, 3% for Chime. SoFi, we'll have to go down, but on adjusted EBITDA, 18% last quarter. No. That's quarter over quarter. I was like, what the heck? 29%. There you go. 29. That's more like it. Not 3, 29. Now, they had some large expenses because they went public. So don't look at this net income assuming that it's going to be this way forever. But even before they were public, you'll see this choppiness through the business where sometimes they're profitable and sometimes they're not. Now, if you go all the way back, yes, they were losing a lot of money. Okay, SoFi went through that phase as well. SoFi, if we take a look at this line here, was extremely negative. You can see by the margin underneath highlighted in red. But the second that we turn positive and red goes to green, they never looked back. That's not the same rate that what I see from Chime. Okay. Chime, you see the margin or in brackets, big negative, positive, negative, negative, positive, positive, negative, negative, negative. Like, so where's the multiple for consistency, you know, for having some execution credit here? Like, anyway, obviously they try to take advantage of the potential growth. And for active members here, you can see they've gone from, wait 1 second. Yeah. Active members ended up going from 8.6 million to 8.7 million. Now, to make this exact comparison to SoFi is hard because we don't show off active members the same way that Chime does, which I'm pretty sure theirs is active members. You have to be active in the last either month or 365 days. I forget which one it is, but ours is total. We still do churn. So if people are not using it, they've deceased. They haven't used it. Like the accounts are completely unfunded after, I think it's like 90 days or something. Then we write those customers off. Okay. So it's a little bit different, but the growth rate should be very similar. The reason I say that is if you're assuming that their total member growth is happening faster than active members, then you're essentially saying that people are liking the app less and less. that if they're growing their total member base at 35%, but only 22% is actually active, or 22% year over year is active, then that's not a good sign at all. Okay. If you're saying that SoFi's active base is, potentially smaller than this, well, their revenue growth and stuff like this is actually showing that it could be even faster than, the 33% year over year on new members. Because new revenue went up like 44%. So maybe there's more active customers and more active line items now than there were before. So let's take a look really quick at Chime's active member count. I do not have as many charts. And let's bring that up really quick. There we go. And you can see that this percentage, which hopefully we can bold and make a little bigger here, not that big, is not quite comparable in the 20% ranges. And in the last 2 quarters, sort of flattening out at 22.9 to 22.5, even remotely close to the 30 and 40+% growth rates of SoFi in the same period. 44, 46, 44, 43, now 33.8% growth year over year on new members. Okay. Chime's doing this at a smaller base, 8 million. And you're growing 22% year over year. I'm just not that big of a fan of this statistic versus the ones that we're seeing at SoFi. I don't like the margins that we're end up seeing on adjusted EBITDA. Okay. I don't like the growth rates at 37% versus 44% year over year. I don't like gross profit's a little bit hard. SoFi does have a cost of revenue, but it's not quite the same because we have a lot of loan products and stuff. So it's very different from them. But yeah, you can even see like another thing that someone pointed out while listening to their call. They kept highlighting that they have seasonality in their spend. Okay. You can see here, Q1, big boost. Q1 has a big boost. Q1 of 2024, Q1 of 2025, it's always a little bit higher. And they said something along the lines of tax benefits from people getting checks from the government that they end up spending. So they have larger spends during those periods. It's insane. The problem with Chime too is that as they expand out into new products, they lend themselves to more lower income individuals, which is perfectly fine. Okay. The problem is that if you are more paycheck to paycheck, there's a higher likelihood that if something goes wrong, if you're, a roof caves in, if you get a flat tire, if whatever, that you won't have money to pay back your loans. So Chime has to be very selective with how they grow into credit card products, how they grow into, small dollar loans and Spot Me and all these different products that they're getting into, which I think are good and they're better than payday loans that their competitors are into. But still, it's not like the quality of the member that SoFi has, that even in a recession, they usually do better than the overall market because they're not just prime users, they're prime plus. And we see that from the 760 FICO scores and above and stuff like this. Okay. Now, what we can also do, why don't we go? I was trying to chart out the member growth here. So we don't have a ton of data, and because of the way that Chime reports it, they only report in 8.6 mil or 8.7 million. Here, wait, let's see if I can. Because it says it is reporting in millions, and this is reporting in flat numbers. So I wonder if, where am I seeing? Oh, sorry, it's up here. Now, how does that make sense? Oh, because it's not on the same axis line. I was like, how is it growing faster? That doesn't make any dang sense. So if I put it onto, yeah, it's just not going to sync up well. I wish that it would not be on a different axis and it would just multiply it by 1 million, because that's dumb. But that's just the way that they report their numbers, I guess. Oh, well. But you'd be able to see the difference in the growth rates. And actually, I think I did that once before where I ended up tracking their members. I'm sure I could build that chart really quickly as well. Let's just see here. So how far back did that go? Okay. I'm just going to build that chart so then you guys can see what that looks like. The difference between Chime and SoFi over time. Keep in mind that, you know, it's not completely accurate. We just add the date here, and then I'll add members as well. So in orange, you have SoFi's members, and then in blue is Chime's. I'm actually going to take away this because it just bogs it up too much. But in blue, you have Chime members. They're active. And here you have SoFi members total. Okay. And look how Chime used to surpass SoFi before. Oh, sorry, you don't see the dates there. Let me just add the axis. Not that one. This one. Yes. Okay. So here you can see. Why is this doing this? Why do I have this wrong? What's going on? I don't know what's going. Oh, sorry, custom currencies. See, the problem is my thing is right in my way. My camera's right in my way, so I'm kind of guessing where my mouse is clicking. Anyway, you could see over the first 4 or 5 quarters that Chime actually had the advantage on SoFi, but because of their accelerated rates of growth, that SoFi has actually passed them. So you're assuming either two things: that one, Chime has a larger total base of growth, and that those users are being less active over time, or SoFi's active base is somehow getting worse and worse over time, even though they're growing revenue faster than Chime. So both don't make a lot of sense. I think that this is an accurate representation, assuming that they're both growing, you know, at that same sort of rate. So there we go. Yeah. In that same breath, maybe we can play around with the multiples. But yeah, the only problem is that Chime literally has no data. That's the only problem. If we go to chart the two, they're just so like brand new. But we can try here. I'll even check on a forward basis as well, because maybe there's something in that regard for the difference between Chime and SoFi, for example. Okay. Let's try to let me bring up Chime. Honestly, this might be a better idea for a video, because it might take me a little bit to build some charts here. And then maybe in like a 6 or 8 minute video tomorrow, I can just show you guys a couple different charts comparing their valuation. And then you can tell me which one you'd prefer based on the growth rates, based on the margins, based on the rate of execution through any through any macro, which one you would prefer. Tanner's coming in with the receipts. We're all about the data here. Hopefully you guys enjoyed that 1 hour of essentially SoFi versus Chime. I can field some questions, but there's not too much direct things that I can show now. Oh, sorry, there is actually. There actually is. Chime, I was going to say with the purchase volume, has this seasonality where they continue to find times where their investors, or sorry, their users want to spend more. By the way, they had all these bogus charts about how they're the 5th largest debit card issuer, and how there's only a few select large banks that dominate them. By the way, Cash App wasn't even there. Cash App has 3x the amount of Cash App card users versus Chime. Cash App wasn't there. So it was just all made up. No Venmo, no Cash App. They're only comparing against the big issuing banks that they have data on. They're not including any fintechs, but yet they're including themselves. It's not real. Don't believe it. No way a company with 8 million actives is beating a company that has 57 million actives and a confirmed 23 million monthly active card users. Come on now. SoFi inclusion next year? No, September. I mean, it is a possibility that we get in earlier than people expect. Here's the thing, is that I think that they're trying to balance the best companies to show off what the top 500 businesses in America will be, but they also have objectives. Like, they're not putting in the largest business that they can put in with the fastest growth and the best margins, or else they'd put in AppLovin, right? AppLovin's rule of 40 is like 158 or something like this. And their market cap is about like 150 billion after today. So that's been a couple times where companies have gotten in before them where we would have thought that AppLovin should have gotten in. By the way, I have a share of that company now. Or I have share of that company, not a share. And the other part is that SoFi plays a unique role in being an actual bank and a fintech, and very diversified, very true to its technology and financial structure. So if they are looking for a bank, Robinhood does not fit that role. Okay, IBKR does not fit that role. SoFi fits that role. So I'm curious if SoFi does end up getting in before Robinhood, because Robinhood should have been in by now. So maybe they really do not want brokerages right now. Maybe that's because they're almost levered bets on the S&P 500 in general. So it almost like it just increases the volatility of the fund. I don't know. But IBKR is not in and Robinhood's not in, and it doesn't make a whole lot of sense to me. So we shall see. Hopefully SoFi gets in. Stole my argument? Yeah, did I? I forgot to read your blog this morning. How'd you feel about the trade desk earnings and stock price movement? So I bought this in the after hours as well. I was a shareholder before, so it's not like I'm just benefiting from the fall. I'm mixed, man. I like advertising so much. I like the total addressable market so much. Do I think programmable open internet, advertisements are going to do well? Yes. Yeah. Do I think the trade desk is going to do well? Well, I'd like to think so, but guidance does not look good. This growth, 19% is not what I want. I either want this business for 25 plus or 30 plus % growth going forward. 19 does not cut it. They also said things like Kokai, which is their new AI-driven platform, which should be much, much better for their users. Like they said, it's next generation. It's the best product they've ever advanced to in their company's history, is only doing 3% of the volume that they're doing right now. 3%. So whenever you transition that other 97%, which should happen this year, what does that do to the business overall? I'm still very hopeful. I'm going to hold the stock and buy a couple more shares in the after hours while it's fallen 28+%. But yeah. Also, whoever donated ABCL to the community fund, I'm going to give you a kiss. That's incredible. That is incredible. Up another 21%. Let me just check. By the way, I still need to update the trades, guys. I will do that probably tonight, but like during these times of like insane earnings where I'm going live in the morning and at night, like Chime did their call at 6. The trade desk did their call at 5. I went live for 3:45 and didn't get off till 7. Then I had to be live again at 8. When do I eat dinner? You know, it was between that 45-minute period. Shout out to Subway today. But yeah, I will update it. My apologies. But let me go see who donated Abcelera, because whoever did, that is mint. Search for Abcelera. Abcelera was Dookie Pie. Oh, all right, Dookie Pie. I didn't know that. All right. I don't mind. I don't mind. It's a pretty decent donation as well. I mean, it's from Dookie Pie, so it was Dookie. I'm lying. No. I have the receipts. You're not lying. You're telling the truth. Look, I've got the receipts. I'm reading the report. She said ABCL and then donated another 20. I put 120 in Abcelera. So don't mind if I do. W Dookie. Oh man, I wish she changed her name. All right. Let's sorry, I was going to talk about something before I ended up bringing that up. Yeah, the trade desk, I'm buying it, but I was going to talk about something. Oh, we were going to do questions on SoFi and Chime. That's what it was. I listened to the full earnings call. Oh, no. Oh my gosh. It was the freaking spend, the seasonal spend. You guys are getting me distracted. Okay. So you saw Chimes. I'm not going to rehash that because we already did it twice. But now let's take a look at SoFi's. Okay, because they have spend as well, but no one seems to pay attention to that. It does make up for a small percentage of their overall earnings. Actually, we can check. Interchange volume made up for... Interchange was 26.5 million this quarter, which is a run rate annually of 104 million. A quarter. 104 million. It's 43% of all non-interest revenue. But this is why having card programs and like why I'm super excited for them to get into secured credit and another credit card and just expand that offering and get more people into SoFi Money is it's a huge, huge marketplace or huge total addressable market. So yeah. But if we go ahead and look at the spend, which I should be able to find. I thought I had a chart about it. I freaking put it in my next video coming. Oh, there it is. Show me the seasonality here, ladies and gentlemen. Show me the freaking seasonality here. Oh, it's a masterpiece. So you have, let me full screen that for you. You have, this is both debit and credit cards, and just climbing up every single quarter, zero seasonality, and the percentage in which people are spending per money account has gone from $196 to $764 of spend per person. So every new person that's coming on that's like barely tapping their card, the people who are getting used to their credit cards are just bop, 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 just tapping it everywhere they can. It's hard to grow users at the speed that SoFi is growing them while still improving the per user like monetization. That is incredible. That's very hard to do. SoFi did it, or doing it. And these are big jumps. It's not like it's even stalling. I mean, we're making big leaps here. Incredible chart, someone said. Adam Gibson. And another chart that goes along with it pretty well is deposits. More customers are putting more money on SoFi's accounts. This is starting to stagnate at the 4,600 mark, but people have not begun spending enough. I'm curious to see where it settles out at, if it does. Do we get thousands and thousands of dollars of spend per member? You know? And what do they do with the remaining amount if they're not spending it? Do they put it into SoFi Invest or something? Who knows? Okay. Let's take a look at other stories of the day, and we can also field some Q&A as well while we're here. Did you guys know that the mortgage rates have been dropping for the third straight week, now the lowest since April? 30-year fixed hit 6.63% per Freddie Mac, down from 6.72% last week. Redfin says incomes need to buy a typical home fell year over year in 11 major U.S. metropolitans, mostly in Sunbelt cities where prices are cooling and listings are stacking up. Phoenix, for example, has been a buying market for almost 8 months now. Incredible. Incredible. On that same breath, you have SoFi ending up tweeting about how now is a better time than ever to get a home loan. So you can see that the ambitions that SoFi has as they tweet out, hey, got big home ownership ambitions. Mortgage rates just recently hit a 10-month low. Now's a great time to check on your, what rates you can get. So let's hope that actually translates to not just from that tweet, but the campaign of trying to push members to home loans now, especially members that are already existing. We showed this yesterday, but I think it's just so powerful of the flywheel that starts to like that we start to get is, hey, if you're a SoFi Plus user and you want to fund an active invest account, get 2 times the welcome bonus. They'll pay you, but this is cross-sell. And the cost of giving someone 2x welcome bonuses is not nearly as much as what it costs them to put up Facebook ads and Google ads and all of these things to attract new members, to not even guarantee that they get SoFi Plus in the first place. But yeah. Rate cuts coming in 6 weeks? Yeah, I think so. I think we get rate cuts in September. I think we get more rate cuts throughout the rest of the year. Yeah. Tanner, I had to buy some Fortinet today. What do you think? I don't think too much about Fortinet. SoFi will cut APY soon from 3.8 to 3.5. It's true. They will. But so will all their other competitors as well. You know, SoFi wants to be in the top 80 to 85% of the fintechs that have really attractive rates. And then they can also add bonuses to that as well to say, hey, you know what? Become a SoFi Plus member today and you get 4.5% APY for the next 6 months. And potentially they lock in a customer for, you know, a small added bonus that's temporary. And maybe you're locking in a pretty high lifetime value per customer, which is exciting, which also Chime talked about a lot today, which is their 8x LTV to CAC ratio, which is amazing. And I wish SoFi talked about that as well. They also talked about a churn rate of 50% in their first year customers that they end up getting, which was crazy. I'm curious to know what SoFi's is. What happened with Tesla's Dojo? Well, I don't know what you mean by it was supposed to be one of Tesla's verticals, but I did end up seeing that they ended up picking out chip suppliers for Tesla Dojo yesterday, I think, or this morning, that also said they were going to use Intel and Samsung. Now, the reason why I find that that's exciting is that why are they stepping away from TSM? Is it because they can't offer them the services that they want? No. It's that TSM is too hard at work dealing with customers that are way bigger than Tesla. Now, can you guys tell me who those customers might be? Who those customers might be that TSM, Taiwan Semiconductor, is too busy dealing with? Not SoFi. Thank you, W. Appreciate that. NVIDIA, ladies and gentlemen, they're too busy dealing with NVIDIA. So, yeah, that's very, very exciting. The fact that, you know, Tesla has to go somewhere else to supply their chips because there's just too many NVIDIA chips going out. That's a lovely space. SoFi's taking all the chips. Yeah. I think someone said that to me one time when they said, they were like saying how SoFi does not deserve a premium. And I was like, oh, why is that? And they said, how many GB200s are they buying? I'm like, come on now. Like the only thing that deserves a premium is if it's trying to set up a data center. Who do you think is getting all the revenue to AWS and Azure and Google Cloud Platform if every company has to buy their own chips? You know, the 99% of customers should not be buying their own chips. They should be going to the damn suppliers who are offering you the engineering tools and the you know, the tokens. So of course SoFi is not buying chips, but hopefully they are buying the tokens that those chips are supplying, which would be through a cloud provider, which would be for artificial intelligence products, which is what Anthony Noto has been talking about, is what they're working on. What would you buy at this point, Nubank or SoFi? Well, you know what's funny? I'm actively buying SoFi right now and not buying Nubank. I feel a little bit bipolar saying that, but the market just seems to change very quickly. So it's not like I'm selling. I have not sold a share of NVIDIA or of Nubank, but I think that SoFi, after the last quarter, I've just realized that, like, oh wait, you know what? Noto said he could reaccelerate this business, and until now, it was like all talk, and we were slowly like slowing down. But now I'm like, okay, he could actually bring this to $50. He could actually bring this to like really high double digits if he can get us to 50 million users. And whenever I heard 50 million, I was like, that's dumb. You know, they can't do that. But now he's just proven that they can keep customer acquisition cost at a similar rate and just jack up. They can just jack up, like, what do you call it? Sales and marketing. And for every $300 that they spend, they get a new customer. So if that math holds, if for every $300 they spend, they get a new customer, that's a personal loan customer, a home loan customer, a SoFi Money customer, whatever, you just need a lot of money. You know, and they're making a lot of money from their customers, and those margins are improving, which means they should be getting $300 quicker. So if they can get $300 quicker, they'll get a new member quicker. And that cycle is just going to continue and continue and continue, assuming that they hold up the $300 CAC. Would you load up on Shopify even at these hot, spicy prices after earnings? No. Love me some Shopify. Love it being where it is today, or as a percentage of my portfolio. Tanner, what's up, dog? I'm here from a Mitts channel. Nice to see you, H3. Thanks for popping in. SoFi potential uses for AI only for fraud detection or financial coaching tools. They don't really need fancy AI chips. Yeah, I mean, for the most part, that's true, right? There'll be some other stuff probably in terms of the way that they run some of their ETFs and, you know, personalization on their products. But we'll have to see how financial apps like that's the thing about SoFi that I'm really excited for. If you follow in the case of Nubank, which is what I think will be the use case of SoFi, is right now, or let's say 2 years ago, Nubank was a financial services company, but now they have a SIM card. Like they have a new, like new SIM card, new cell. And so now they're making non-financial revenue from ancillary products that they're selling out to their customers that they can add on to their suite of products. Same way that Amazon Prime would do that. Hey, you know, you're a Nubank Plus member. Well, you get all of these additional discounts because you're a very deep integrated customer with us, and it makes customers more sticky and everything like this. Everyone talks about financial services as if a telecommunications company or a hardware store or an e-commerce store can get into credit cards or debit cards, or hotels can get into credit cards because, you know, there's rewards points to be gained. That's all been done. What I think is going to happen over the next decade is you're going to see all of the financial services, new age financial services, the Robinhoods, the SoFis, the Nubanks, you know, all of these go start from financial services and go outward. You know, how did they go from financial services to a sales portal? Like maybe SoFi partners up with Shopify or something like this. So then you can have a pay by SoFi button in a Shopify account or in a Shopify portal. Maybe they do the chip part. Maybe they get into, like, I don't know. Okay. But there was a lot of benefits, like what you see with Grab, with ride hailing. What is it? Rappi? Rabby? I think it might be Rabby. The Latin American fintech super app, where they have grocery delivery and ride hailing and all of these things that all started from a bank. Interco, you can see another fintech like that that's growing outside of financial services and into traditional non-financial services products. What is stopping SoFi from going into these sort of products? And they don't really need to create their own systems. They could just partner with Instacart, partner with these sort of businesses. They're already starting to do that with SoFi Plus. You can see additional discounts for SoFi Plus users for CNBC Plus and different medical services and estate planning. They're not doing anything for those, and yet they get paid every single time they send someone over there through referral. Like, the referral marketplace can be unbelievably huge. And the one thing that SoFi has is users. They own the user. And if you own the user and you have the bank and you own the deposit and everything like this, you can go a long way. And you can get into travel services and helping people book hotels and all of these things, all through your directly connected bank. or pay via Robinhood button. I'm not suggesting that Robinhood won't do this as well. I think they all will. But this is why I've been really interested in fintech, is that like, I think that they have the same sort of benefits that maybe a SaaS company would, but yet they already have your directly connected financials, which might be a hard part in order to integrate. Damn, Tanner, talking about Rappi. You can come hang out with me in Colombia with me now. Yeah. The only reason why I know about that is the partnerships through Nubank and stuff like this. I also read like forget how long the report was on Rappi and how they expanded. But yeah, I think you get Rappi Prime, which is what their version of like Amazon Prime is, or I don't know if there's another word for it, but it's like the Rappi Plus. You get it free, I think, with a Nubank ultraviolet card or something like this. There's some connection between those two businesses. Melly is going fit. Melly's been going fintech for a long time. But yes, they are definitely going. They're making billions and billions of US dollars on fintech. Get your water in, people. Get your numbers up. I don't know if I have anything else to give you guys. OpenAI showed off ChatGPT 5. It looked all right. Some people got, I think, a little overhyped. And so people weren't super happy. I do want to show you guys this chart, however, because this was crazy. The top 10% of U.S. stocks now reflect a record 76% of U.S. equities in the market. We are in uncharted territory right now. There's a brand new high that the top 10% of largest U.S. stocks make up for the most percentage of the rest of the U.S. equity market. But it doesn't feel too bubbly. That's sort of the thing. The large Mag 7 that is making up such high percentages of the market really are accelerating their earnings in very fast ways. But this is what tech allows. That's another thing that I find funny is like people say, oh, well, that hasn't been around since 1929. So this is why it's a bubble, because there was a big bubble back then, you know? But also the ability to scale your business was not as easily as it was in the internet, where you're able to just hit, okay, publish this new thing and let's make sure that we have the computers to handle the capacity. And oh my gosh, we have this, you know, Microsoft is growing at these insane rates, at insane premium. Like, I don't know, maybe we have more leverage than ever, and that's allowing to give premiums to some of these large companies. And in the face of AI, that's just, people are putting respectable multiples on companies that that can grow very fast. The rich get richer, I guess. Yeah. Hi, Tanner. I think you might be my favorite Canadian YouTuber / financial analyst. Well, I appreciate you prefacing that with Canadian. It puts me in this short list of me in the plain bagel and Canadian in a t-shirt or something like this. Tevis, I guess. But thank you. I'll still take it, baby. I mean, if I'm anyone's favorite anything, that's awesome. Community fund? Yeah, there was no additions today, but we can still take a look at the portfolio overall. We're starting to make a recovery. SBET's up 5, SoFi's up 2.8. Not bad. But to be honest, I just feel a little bit guilty because I have not added the recent couple days of purchases to the fund just yet. Because I've been insanely busy. That's why I should probably go from here soon and get back to work because I got to upload a video that should have been uploaded 2 days ago, and I want to make a video on Chime, want to make a video on App Lovin' and TTD, and there's just way too much for me to do. Try to balance some level of taking care of my health, and my girlfriend always wants to hang out. Gosh, you know. Yeah, SBET, wait till you see this. This is the problem. We're down 37.5% on SBET overall. This is not my portfolio. So for anyone popping in and seeing this, this is not my portfolio. I mean, it is mine, but this is the chat's donations that fund this. So although I am adhering to this and purchasing these companies, however, I haven't in the past few days, but I've kept track of all the ones. So don't worry. I'll retroactively add them all in. And maybe some of them will be at lower prices. Some of them will be at higher prices. But hey, that's just what it is. SBET tanked it a little bit. It did. But I honestly have high hopes for it. It's in my own portfolio now. But yeah. Show us the value. The value's hidden. Bah. No, I was showing the value for a while, and then I started getting like large donations, and I was like, okay, well, I don't want this to turn weird, so I'm just going to turn the value off, just to, I don't know. Nebius is up 18.5%. BMNR is up 7%. Is this for, sorry, no, total. Let's look at total. Shopify up 33.8%. Palantir up 30+%. BWXT up 24.7%. Kratos up 22%. Rocket up 29%. Joby up 48.5%. Nebius up 30%. That's incredible. But the largest position that we have, so ABCL is up 0.4%, but tomorrow it'll be up more than 20. So don't worry on ABCL. We'll be just fine. SoFi, making up 27% of the portfolio, is up 3%. That is the community portfolio. All right, ladies and gentlemen, thank you all so much for watching. I really do appreciate your time. It's been a busy season, but you guys keep showing up and supporting, and it means the world to me that we had, 800 plus people in chat earlier just listening to SoFi on a day that was, the Trade Desk and Chime and SoundHound, Rocket Lab, all these companies, yet people are still showing up for SoFi. It's incredible. It shows how strong what management is doing, how much money has been made on the stock, and how much longer we think that that's going to continue to happen, right? This is the thing I keep talking to Amit and Roy about, is like, guys, we're finding these companies that are working, but there's no timeline or expiration. Like I could be holding on to these companies 10 years from now, and hopefully they continue to accelerate at 20 plus, 30 plus % rates year over year. If that continues to happen, those are the picks that make generational money, because the years that make 30% years down the line are compounding 30% year over year. But from where we originally started, that could be double, triple, quadruple what we're making before. So it's a long game. I think many people in chat have been here for many years, and I think that there will be many years of us together. So strap in. Only if I continue to put up good picks. So I'm aware there's some execution risk on my part, but I'm going to work hard to make sure that I can be the YouTubing guy that you guys want me to be. Probably be a lot more SoFi, Nvidia, Shopify, Robinhood. I've got names that I just feel like have zero risk anymore. Just so many that like I feel comfortable holding for the next like 10 plus years. And that's such a great feeling. Anyway, thank you all so much for watching. Really do appreciate your time. And bye for now.